Welcome to the Daily Update, where I'll go over the action in the market for Friday, May 3rd, and then we'll see how things look for Monday, May 6th. Had a real positive reaction to the employment situation report. Everything pretty much came in weaker than expected. We did see unemployment tick up to 3.9%, but that number's not paid attention to as much because they changed it a number of years ago with how it's calculated, and there's some manipulation that goes on there. There's manipulation that goes in all the reports that we get, but that's what the market uses to make decisions. So we go with that, and it liked what it saw, and things in the ISM services report didn't really freak out the market. The problem right now is we're turning more positive, and we've actually been able to climb back above the 20-day moving average, but we're right at the 50-day moving average. A lot of our charts are switching over and looking more positive. Our trend chart is not. It's still negative, and there's still some things that are negative for right now, but we are showing some improvement. We're going to have to see, are we going to be able to get above and close above that 50-day moving average? We did close above longer term support, and as I just said, shorter term support. Now we're kind of at intermediate term support, which is just as important. And the market seems to have hung up right there, not only for the S&P 500, but other indexes that I'll show you as I go through the charts. So right at the open, we did have a gap higher open. A lot of the gains were set right at the open because the initial reaction to the employment report was positive, and then that carried over to shoot us higher. We opened above R2 at 51.12. So we're above that 51.10, 51.11 level. That's one long-term area of overhead resistance that we were able to get above, and we closed above that. And then prices fell down to R2. So we came back, and not really that uncommon to see an attempt at somewhat of a filling of the gap. We didn't fill the whole thing because of the higher open, but to seeing some selling into strength. As the day went on, we got back above R2. We hit resistance at the 50-day moving average, which right now is at about 51.29 before closing slightly off of the high. So we're up 1.26% on the day. That's a pretty solid up move, and we were above average with volume. And we are looking a lot better, but we still have some real hurdles to overcome as far as our trend looking more positive and getting above that 50-day moving average. It's still about inflation and interest rates. Now, this week, other than maybe some Fed speeches or what have you, the economic calendar is kind of light in that regard. So the market's going to be pretty much left to its own devices as to whether we're going to go up or down from here. And we want to keep an eye on all the different geopolitical things that are happening. Some comments. The report that came out based on the employment situation, it was very well received. And small caps are back to being positive on the year. They had actually dropped down to being negative. They're still the weakest index that we follow. On a short-term basis, we already have some extreme positive readings. We have the Stochk RSI, the Williams Percent R, the CCI 14, and the short-term stochastics. And you notice there's no short-term oversold indicator. We're seeing a lot of improvement with the slope oscillator that we've been watching, and it's no longer extreme, and it's above its moving average. In the long term, we have our 150 and 200 period moving averages. Those are still extreme positive. And then there's two ways to see that. That's, yes, extreme and due for some kind of a pullback, but we've been pulling back, and these longer term moving averages have been holding up. So that on a positive side could be taken as good momentum. Here's the scenario that we're kind of going with right now, that it's looking like the Fed will leave rates unchanged because this inflation getting back down to 2%, that's been really stubborn or sticky, but we're unsure of the time. And now there's, believe it or not, they're trying to turn this around a little bit and taking what could be negative and turning it into a positive, because the market was starting to fear rate hikes. Well, after the employment report on Friday, it's like, well, that's not looking very likely. And that's what they took as positive news. We had gone from wanting to see rate cuts, and now those are kind of off the table for right now, and the time period is unclear, to, okay, well, now they're not going to make rates go up. So we'll take that as positive. So the market really wanted to go up in Friday's session. The dollar was down and interest rates were also lower. That's also helping stocks, both of these. We closed at 4.5% for the 10-year yield, where we had been at 4.57%. We're still inverted with our yield curves. Sentiment is negative. It's improving. It had been at 36, now it's at 40, but we're still in that negative area. And our trend is still negative. The red line is still on top, and it's a weakening trend. As we're bouncing around more or less range bound right now, the ADX, which is a trend indicator, it's having a hard time figuring out what kind of trend we're developing. And so it's just kind of staying in the same situation that it's been in now for a while. We're below the moving average. We're kind of right on top of the moving average as well, depending on which chart you look at, but we're still above 20. So it is a trending environment, but the red line's on top. So that's a weakening trend. And we're kind of not really moving much with the ADX itself. So that would be a weakening trend. Because of the up day, our bias is positive, and then the last number of days, I've switched back over to mixed to positive. Yeah, we could probably lean a little bit more positive. The market's really been making a comeback, but we're still not at that breakout stage yet, and our indicators pretty much are showing that for right now. The economic reports came out. This was the big report, and the market liked this. We had 175,000 new jobs, much less than the 250,000 they had expected. And so the market really liked that. Last time we had 315,000. That was a lot stronger than expected and was adding to some of the inflationary fears into the market. This seemed to cool that down a little bit. The private payrolls came in a little bit less than expected at 167,000. They thought it was going to be 175,000 and down quite a bit from the 243,000 that we saw last month. The average hourly earnings, this is the real inflation part of the report. It came in up 0.2%. They expected it to be up 0.3%. The market also saw that as friendly. Last time it did come in at up 0.3%. And then the unemployment rate did tick up to 3.9%. They expected it to stay the same at 3.8%. And the work week actually ticked down a little bit, 34.3, where it had been at 34.4 as the as they expected, and it was at 34.4 the last time we had this report. And this is not a real influential report. The global services PMI, it did come in above 50. It's at 51.3, down from the 51.7. So it's showing some global expansion. And this is the other big one, the ISM non-manufacturing, or you could say services. It actually came down. It dropped below 50 and came in at 49.4. They expected it to be at 51.8. Last time it was at 51.4. So taken all together, they could have freaked out about the non-manufacturing dropping below 50. That suggesting more of a slowdown, but the market was really focused on the employment report, and the fact that it came weaker than what we've been seeing lately was very well received. Here's some charts. Looking at the unemployment rate, where it's now ticking up to 3.9%. Still very historically low overall, but it is going up just slightly. And the average hourly earnings on a year-over-year basis, this is declining when we compute it out that way. It's a little bit under 4%. And the non-farm payrolls, the change, it did really drop off from what we saw before. And then the ISM, where we're seeing prices going up. That could be inflationary, but we're seeing the total ISM coming down and actually dropping below 50. But the market didn't really focus on that as much. Some Isabel Net blog charts. Numera, what's their policy rate forecast? Now, this is before Friday's session. They think we're going to have a rate cut in July 2024 and then another rate cut in December of 2024. And this is the median forecast here that's in gray with these little squares on here. And then the dashed line is the OIS forward rates as of May 1st. So take that for what it's worth. They're still expecting rates to come down according to this chart. And then what are the positions right now by asset managers? They're heavily into equities, which could put a little pressure on things. When we get above the 40% level, this works kind of like a sentiment gauge, meaning that maybe it's a little too crowded in that trade. But for right now, it's not necessarily having an impact, but it could as we get further along. GDP, and I'm probably going to show this again in the weekly video because I usually deal with GDP then. The takeaway from this is that we're looking positive going forward, not only with the consensus, but with the Goldman Sachs forecast looking out. And then the cyclicals versus defensives, where we've been going up. That means the cyclicals, the stocks that do better in a stronger economic environment. Now we've been seeing that pulling back. This is part of that growth versus value, discretionary versus staples battle that we've been watching every day. And then I found this on Twitter. This is the quarterly performance of hedge funds. And if you don't know what hedge funds are, I do have a section on that in the course that's posted on the YouTube channel. They're basically like a mutual fund, but it can do different things and usually pay a lot more fees, and it's restricted to people of certain net worth. But they came in at about 5.2% for the first quarter. So that was a pretty good return for them. And the cycles chart, not sure where we're at here. We might be going up, as both of these lines tend to be going up a little bit higher now throughout this cycle. So here's our intraday chart where most of the gains were seen right at the open. We opened above R2. We came down, dropped a little bit below R2. We're able to get back above it. And we're kind of dancing along this 51.25 level. And then we ended up closing down just a little bit off the high. So most of the gains were seen before the market even opened. Here's our intraday chart. We drifted a little bit in the initial overnight session that'll close for the weekend now and then resume Sunday afternoon or evening. But this is when we really spiked up before the market opened. We had been looking okay, positive with the futures, but then this is when the report came out, and then that carried over into the cash session. We did see an improvement with growth here, where the blue line is now back on top of the red line. So intraday, that's looking better and more positive for the market. We also saw an improvement here with the S&P growth to value ratio, where it had a pretty good day. It's not breaking out above these previous highs yet, but it has been showing some improvement. Our end of day charts, where growth was up solid, 1.92% versus up a little over 0.5% when we look at large cap value. It was up more for the mid caps and up more for the small caps. So growth had a pretty good day on Friday. Our end of day charts showing some improvement here with small cap growth to value, but not really breaking out yet. And mid caps growth to value, a little bit of a tick up here, but not really showing any real strength at this time. And also bouncing back up a little bit more with the S&P growth to value ratio, but not really breaking out, just kind of coming back into the range where we've been. This is showing some improvement though. When we look at these ETFs and a growth to value ratio here, this is coming back up. We're not out of the rainbow yet, but we are really showing some improvement after we had come down to that 250 period moving average. And saw just a blip up when we compare discretionary to staples. So we're still above this 200-day moving average with this ratio, but it's not showing a lot of strength. We're still in an uptrend longer term, but we want to see this break out and show more improvement than what it's been showing. And we did get just a little bit above the 50-period moving average with large cap growth. So that's encouraging. And there are a few charts where we're above the 50-day moving average and a couple where we're below. But this is encouraging that we were able to get back above that moving average. The Wilshire, though, is right at the 50-period moving average. And this is a broad market measure. Looking at our trend, where we're going down with the ADX below the moving average and kind of still right on top of it. The red line is declining, but it's still on top. We have not seen a cross yet here to turn the trend more positive. And we're seeing that same thing, a decrease in the trend, still above 20, but the red line, even though it's declining, is still on top in the short term. We did get above average with volume, and that's been picking up fairly well lately. As far as sentiment, this came out a few days ago. We're pretty much neutral right now with the latest reading, and I'm not sure why there's no chart there. Okay, this is a very important chart that I'm sure you'll get lots of insight from. The Ulcer Index is coming down and starting to drop below its moving average. If we continue to drop below this, if the market turns more positive, I'll probably drop this chart for a while. And the VIX did come down with the up day. We're coming down with the line chart and the bar chart. So that's just showing fear is decreasing. This is, to me, a little bit concerning because we're getting very low readings now with the VIX of the VIX after it really spiked up here. But you can see with the bar chart and the line chart, it shows the volatility of the VIX is really dropping. And sometimes this can make the market a bit vulnerable. Here's another chart of the VIX and the S&P taken from Real Investment Advice. This just tracks the S&P 500 and then what the VIX was doing at that time. The momentum of the VIX continues to be down as the VIX has been falling. The put-call ratios were not updated, so I can't really give any update there. We are dropping off as far as volatility risk premium. We're dropping below this band, and we're coming down to a fairly low reading, which sometimes can be a little bit vulnerable for the markets. We did decline with this fear gauge, and we ticked down just a little bit with our other fear gauge. Advanced decline line showing some improvement here. We haven't come back to these previous highs yet, but we are continuing to turn up and we're above the moving averages. This is still one of the more positive areas right now that I see for the S&P. We did see a breakout of the new highs, so that's healthy, and it's keeping our 5-period and 10-period continuing to go up, and we're just not seeing much of an expansion of new lows. We did cross back above zero again, and we're looking a little more positive here with the advanced decline ratio. We're coming right back up to the moving average with accumulation distribution. So this is more neutral right now. It's showing some improvement, so you could put a positive slant on it, but we want to see this break above the moving average and then stay above it the way it did back in November all the way up until about the middle part of March. Chaikin money flow is still negative, but trying to turn back up a little bit, so it's showing some improvement. And we're just barely negative here with the Chaikin oscillator, just slightly below the midpoint. We did see an improvement with the cumulative advanced decline line for the S&P with the up day, and we also saw an improvement here with the NYSE regular advanced decline line, and also an improvement here with our other NYSE advanced decline line. Looking at common stock based on price for the NYSE, we did show some nice little bouncing here, and we also bounced up based on volume, so that's improving. And we're above zero with the new highs minus the new lows, and that's for the NYSE, so that's still looking better. With the cumulative advanced decline line based on price for the S&P, we did go up, and we also went up based on volume. So these are improving charts, but not necessarily breaking out at this point. And we're looking better here with the NYSE common stock. Looking at our advanced decline line studies, we came back above the moving average, slightly above the moving average with the S&P, looking a little better with the mid caps, and the small caps kind of had some strength in Friday's session, and they're showing some improvement. Here's our short-term chart where we're right at the 50-day moving average. And the market knows that, and the smart money knows that. And so this makes it still a little bit indecisive. Until we can get above that 50-day moving average and then close above it, we still have to treat this with some suspicion. We did see volume above average. Stochk RSI getting back to an extreme positive reading, which may mean that we're going up too far too fast. That's kind of the negative slant. The other slant is that we could stay up here for a while, and that would also suggest good momentum. And kind of the same thing here with the Williams percent R, getting extreme, but it can stay up here for a long time if we stay positive. The CCI 14 is starting to get extreme. The CCI 20 is not on the list yet. And this usually doesn't stay up here for as long of a time. It's a little more volatile of an indicator. And here's our 20-period moving average, where we were able to get above that. And now we have the 20 below the 50. So that's also somewhat negative. So we were able to get back above the short-term moving averages. And here's our 20-period moving average study for the double and triple exponential moving averages, where we're coming back above both of the lines, and the lines are starting to turn up. If we can hang on to that, that is positive. But we're still right at the high end of this mini rainbow here. We're a little bit above it right now, but we need to see, again, some more follow through with this. We're going up with the 20, 50, and 200 period moving averages. And that's just on the S&P itself. That doesn't look internally. So this is back to looking more positive. We did cross above zero with the force index, so it's turned back positive now. And we're already extreme in the short-term stochastic. We're crossing above the midpoint in the intermediate short term, and we're looking a little bit better in the long short term. And the reason why I say that is this is a further subdivision of the short-term time frame. We got above the midpoint with the standard deviations chart, so that's more positive. So we're up into the +1 standard deviation now. Intermediate term, we did bounce back up with the balance of power, but we're still below 0. So that's still negative, but improving. And we turn to a lighter shade of purple now. So that's showing some improvement with the go, no-go system. And we're getting above the midpoint with our highest high, lowest low values. The TTM squeeze is continuing to show some improvement. We have the lighter shade of red, but we haven't turned positive yet. And here's our double and triple exponential moving average based on 50 periods. We were finally able to clear the triple, but we have not cleared the double yet. And here is our 50-period moving average. We're right there right now. We were able to get above the exponential moving average, but the market tends to focus more on the simple moving average, and that's where we ended up residing. The 100-period, we're just watching this in case we do see some weakness, seeing if this will offer some support. The ease of movement is showing some improvement, but still below 0. The rune is pretty much sleeping right now. We are looking positive now for the second day with the S&P McClellan oscillator. We're above 0 and advancing, so we're ever so slightly starting to turn back up based on price, and we have been going back up based on volume, showing a little more strength there. With the NYSE McClellan oscillator, we're above 0 and advancing for 2 days now, so that's showing some improvement. So we're turning up with the summation index based on price as well as volume. This is rather critical here. The Swenlin trading oscillator was actually dropping even as the S&P was showing some improvement. Now we were finally able to see this turn back up and turn positive based on price as well as volume. But the momentum in oscillators that we look at, we're still negative with the PMO, but we're crossing over positive based on price and turning up after being flat based on volume. We're seeing some improvement here with the PMOs that are rising. The buy signals are starting to go back up, and we're turning up just slightly with the PMOs above 0. We've turned over to positive with the Elder's Impulse system for the S&P. We're still positive with the parabolic SAR, and we're no longer extreme. We crossed back above this red line, and we're above the moving average. So the slope oscillator is continuing to show some improvement, and we came just a little bit above the moving average with the MACD. If that can continue and eventually get above 0, that would really help this look more healthy. So with our oscillators looking a little better in the short term, showing some improvement here with the MACD, the PMO is still negative. We're crossing positive with the PPO. We're turning up here with our longer term oscillators, but we're a little far away with the tricks. We're coming up to the moving average with the KST oscillator. And right now we're at the 50-day moving average. And the BPI did show some improvement. We're above 50 and climbing. Nothing really all that strong right now, but it is showing some improvement there. And the NYSE bullish percent index is above 50 and advancing, so that's improving. We're still negative with the NASDAQ 100 bullish percent index. It's going up, but it's still below 50. It would have to cross above 50 to turn positive. And the money flow is bouncing up, but still below 50. The ultimate oscillator just barely crossed above 50, so it's turning slightly positive. Here's the vortex. The red line is still on top, even though it's declining. The green line is on bottom, but it is advancing. This isn't going to turn positive until we see a cross on this chart. We did get back above 50 with the RSI 14 and the RSI 9, so that's just showing this momentum is looking more positive. We're coming back up to a declining moving average with on-balance volume. We want to be able to break above that and then see the red line turn back up to turn more positive. We're doing better here with our 20-period moving average study of those stocks inside the S&P. We finally crossed above 20, but we're still below 50 with the 50-period moving average study, but it did bounce up. We turned up with the 100-period moving average study, and we're also above 50. And we turned it back up with the 200. So we are seeing some across-the-board improvement here. Copic curve shows that the momentum is positive according to this indicator. We're going back up with the Sean trend meter, and we are still maintaining price above this Ichimoku cloud, and we were kind of following along it, and it was providing some kind of support. The Pring bottom fisher is still generating a buy signal, so that could end up being positive. And the mass index, we're getting just a little bit above blue. So if we roll over and start to come down and cross below the red dashed line, this would suggest a change in trend. It's a little early right now to say what's that going to be, because we could say it's positive, but a lot of our charts are still looking negative. So we kind of have to see what's going to happen with that. Our different charts, we're looking more positive with the Heiken Ashi. We're positive with the Kagi chart and pointing back up, but we're negative with the Renko chart. We're looking a little more positive with the 3-line break. Long term, we did close above this long-term R1 pivot level. This is a weekly chart of the S&P. So this is showing some improvement. We wanted to get above it and then close above it on a weekly basis, and we were able to do that. Excuse me. We're turning back up with our 150 and 200 period moving averages, and we're above these red lines, and that's why they're extreme positive. And we're back to looking positive across the board according to the Keller market model with all the different indexes and time frames, where we're still negative with the price across the board for bonds. We're still going down with commodities, and now the dollar's been under some weakness lately, so it's in a short-term downtrend according to this. No change in the decision point scorecard. We're still negative in the short term, positive in the intermediate term, and mixed in the long term. Saw a lot of blue or green, depending on how you see this here. This one red area, that was the dollar going down, which actually supported stocks. And then energy, it crossed below 80 with the bullish percent index. And that's where a lot of the strength has been coming from. There was some weakness in that area in Friday's session, where here the S&P did get above 5,100. And we saw a lot of good construction across a lot of the different sectors. And the NASDAQ ended up having a pretty good day as well. So we're turning back up with the S&P chart as well as the S&P equal weight chart. And mega caps did outperform, so we're seeing this going up, but we've been just chopping a lot of sideways lately. We're not really showing any kind of an upward thrust or even a downward thrust right now. The Dow is right at its 50-day moving average, maybe just a tick or so below that. The diamonds, though, have switched over to positive for the Elder's Impulse system. We're a little bit above the 50-day moving average with the NASDAQ, and that could be encouraging. This is an area that works in tandem with the S&P 500, and the fact that we were able to get above that could be more positive. And we're right up to the 50-period moving average with the NASDAQ 100. That works even more in tandem with the S&P, since the NASDAQ 100 stocks are also in the S&P 500. So we do have some overhead resistance that has not been dealt with yet. The Elder's Impulse system for the Qs is back to positive, and the momentum for the NASDAQ 100 is starting to turn up and above its moving average. It's still below zero, but if it can keep going up, that would turn the momentum more positive. And we're right up to the 50-day moving average with the QQQs here, still acting as overhead resistance, not only for the S&P, but here for the Qs and also on the NASDAQ 100 chart. Small caps, yeah, they're still kind of getting a little further up into the range that they've been in, but they did get above their 50-day moving average, and they've turned to positive, or I should say remain positive for the Elder's Impulse system when looking at the small caps. And we're breaking out a little bit above this support resistance level, and we're kind of battling, we're kind of right on the 50-day moving average here with the Russell 2000. The momentum is turning back positive. The longer-term trend is still positive, and we're breaking above 50 with the RSI. With the mid caps, also right on the 50-day moving average. So now that's our third index that could not close above it. It spent time above it, and some may see that as a failure. Oh, it's rejecting its 50-day moving average. No, they're right at it right now. It's where the market wanted to be by the time we closed. We're still positive with the Elder's Impulse system for the mid caps. Apple, they had a really solid update. They're above both of the moving averages, but we're still in a downtrend with Apple. And Tesla it was little change. It was up 0.2%, which is not very big when you're looking at Tesla. It's coming back above its 200-day moving average, still below its 50, and we're still in a downtrend here. NVIDIA was up almost 3.5% and is climbing above its 50-day moving average, so that's positive. Microsoft is still under its 50-day moving average, but it was up 2.22%. Meta, which gapped lower, now finally is breaking out of this choppy sideways range it had been in for a few days. It was up 2.33%. And Amazon, which reported, they reported a day or two ago, but they're looking better. They're above their 50-day moving average, and actually they closed off the high though, and we're not setting an all-time high yet with Amazon. Google, which gapped higher after their earnings, is still pretty much chopping sideways after it had been falling back. The FANG index did close above its 50-day moving average, so that's more encouraging. This would mean the mega caps, the big ones, and the fact that this closed near the high and above its moving average is more positive. The financial sector's still just right about at its 50-day moving average. And we're coming down a little bit here with the staples to tech ratio. If we can continue to go down, that would be more positive for the market. And the dollar is dropping. We're up into the 106 range, then we got into the 105 range. Now we're starting to drop into the 104 range. Looking internationally, where we're seeing the shorter term relationship still getting a little bit stronger, or we're pretty much flat to slightly declining with the longer term relationship. But please keep in mind there's a 1-day lag between the S&P and this ETF. We don't get that until the next business day. And we're right at the 50-day moving average with the total stock ETF. We spent some time above it, but we pretty much closed right at it. We did drop with the 10-year yield, and that gave a lot of support to stocks. So we were up with the 10-year based on price, and we're getting back above its 200-day moving average. Looking at growth to value, seeing some improvement here with the Qs to S&P. Actually, a little bit of a decrease with discretionary to the S&P and coming down to its moving average. We did see a bit of a turn up when we compare large cap growth to large cap value. So with the large caps, we're seeing some improvement. We're turning up. It's still below a declining moving average with the mid caps, and the same thing with the small caps. It did tick up, but it's below a declining moving average. And we're still looking okay here with the 10-day average of the S&P 500 highs minus the lows. This is continuing to go up. So that's showing an improvement there. We're also looking better here with the advanced decline ratio based on 19 periods. We're above zero based on price and volume, and we spent the last couple of days that way. And we're turning back a little more positive here with our 5-day moving average of the highs minus the lows across the broad market. We had been dropping below zero. Now we're starting to come back and look more positive. This is still a little bit of a concern, even though we ticked up barely. This declining is putting pressure on the S&P. We want to see this actually continue to go up higher and turn higher, and that would give more support to the S&P. And we're coming down just a little bit with our staples to S&P 500 ratio, but we want to continue to see this drop for it to turn more positive. And we don't know. We'll have to see. We won't know until Monday if a new ZWAG NYSE breadth thrust was actually triggered. It doesn't seem all that likely, but Friday was a solid day. But was it solid enough to trigger this signal? Because Friday was the close of that 10-day window. So what's our outlook for Monday? In the short and intermediate term, we are turning positive, but we're right at that 50-day simple moving average, and we have to respect that. We're not going to have any economic reports on Monday, and then we want to keep an eye on all the geopolitical things and see if anything ends up bleeding over and affecting the stock market. Here's the upcoming economic calendar for the week. It's lighter compared to what we've been seeing lately. I actually have weekly jobless claims and continuing claims marked out as important because usually I would just kind of let them go, but this seems to be one of the bigger things. And then we're going to get consumer sentiment on Friday. Here's also looking at the chart, a couple of things that I usually don't talk about, the crude inventories. And then I only mention these auctions. We'll have one on Wednesday and then one on Thursday if they have a real impact on the market. Sometimes they do, sometimes they don't. Seasonality, we're negative with the Dow when it comes to May 6th. We're neutral to negative with the S&P and NASDAQ. We'll be on the 4th trading day of the month where we do see some negative seasonality with the green dashed line during an election year. Monday is the most positive day of the week, so that has it more in the market's favor. And we're trying to come back up to this average during an election year based on the Carson chart. Trying to come back to the average here with the Stock Traders Almanac chart. Here's a new chart that was posted, and for a while it was looking like maybe we're going to follow 1968. Well, we really haven't been following all that much. If you know much about U.S. history, 1968 was a torturous year for the U.S. There were a lot of riots, there were a lot of protests. The Vietnam War was really picking up. We had two political assassinations with Martin Luther King and Robert F. Kennedy, not Jr., not the one that's running for president now. It was his dad that was assassinated. And the only good thing that happened that year was Apollo 8 went out to the moon and spun around it 10 times. They kind of saved that year, but it was a real treacherous year. And so they're, because of so much upheaval going on, they're kind of reflecting. Is this acting like 1968? Well, according to what Stock Traders Almanac found, we're actually getting a little closer to what happened in 2012, and that ended up being more positive going forward from here. And then we do, on a seasonal basis, see some weakness in May, according to this Carson chart. So what are our warning signs? I don't know about the equity put call ratio. I'm assuming that it's still, I don't know if it's going up or down right now. So we'll see. The NASDAQ 100 bullish percent index, it's improving, but it's still negative. It's below 50. The Chaikin money flow continues to be negative, but it's improving too, possibly. The Chaikin oscillator is just barely negative, but it is negative. The money flow is negative, and the vortex continues to be negative. And our oscillators, the slope is looking better, but when you take them all together, they're still negative. And we're at intermediate term resistance. That's the 50-day moving average. We got above the short term and the long term. It's the intermediate term that the market's now dealing with. Positive signs. We are positive with the McClellan oscillators for the S&P and NYSE. The STO, the Swenlin Trading Oscillator, is positive, and that's a switch back after it had been looking more negative. The parabolic SAR is positive. We're above 50 with the bullish percent index for the S&P. The ultimate oscillator is positive, and the Copic curve is positive. The long-term trend is still positive. We're turning more positive with the NASDAQ 100 momentum, so that's another new addition here. And the financial sector still continues to be positive, and we won't know for sure. It's unlikely, but hey, anything can happen if we're going to see another ZWAG NYSE breadth thrust. Conclusion. We're negative in the short and intermediate term, but we're at the 50-day simple moving average. But we're turning positive. But my personal stance is that we're not going to actually turn positive until we can close above that 50-day moving average and see some of our other indicators continue to improve. In the short term, we're above the 20-period moving average, but it's below the 50 right now. And we're at resistance right now in the intermediate term, where we still continue to be positive in the long term. Thank you. I really hope you found this helpful. I will be posting all the different videos over the weekend, so I do hope that you have a great weekend, and I will talk to you in the next video.